The year 2025 was not just another volatile year for the markets, it was the beginning of a structural shift that will define the rest of the decade. While the headlines were screaming about new all-time highs in the stock market, something much more dangerous was happening underneath the surface. The US dollar silently lost 10% of its purchasing power in 12 months. If you think that was a fluke, you are mistaken. The forces that drove that decline are not going away. In fact, as we move into 2026, they are getting stronger. We are watching the slow motion dismantling of the financial order we have lived in for 50 years. Inside the global economy breaks down the hidden forces shaping the world economy. Most people look at a currency chart and see lines moving up and down. But a currency is not just a number. It is a report card on a nation's ability to manage its affairs. And right now, the United States is failing that test because it is trying to do the impossible. It is trying to fight a three-front economic war with a checkbook that is already overdrawn. On one front, Washington is desperate to win the global artificial intelligence race against China. On the second front, it is trying to rebuild the industrial supply chains that were outsourced 30 years ago. And on the third front, it is trying to keep the U.S. Treasury market from collapsing under the weight of its own debt. Any one of these goals would be expensive. Doing all three at the same time requires a level of spending that simply does not exist in the tax revenue. So how do you pay for it? You pay for it by changing the rules of the game. You pay for it by flooding the system with liquidity. This is the story of how the U.S. government decided to sacrifice the dollar to save its geopolitical ambitions. To understand why the dollar is doomed to weaken further, we have to look at the plumbing of the financial system. Historically, the U.S. Treasury funded itself by selling long-term bonds, 10-year bonds and 30-year bonds. This was healthy because it locked in interest rates and provided stability. But in late 2024 and throughout 2025, that strategy stopped working. There were simply no buyers for long-term U.S. debt at the interest rates the government could afford to pay. So the Treasury Department made a quiet but radical shift. They stopped selling as many long-term bonds and started selling short-term bills. 1-month bills, 3-month bills, 1-year bills. To the average person, this sounds like boring financial jargon. But to a central banker, this is the equivalent of injecting adrenaline directly into the heart of the economy. Short-term bills are almost like cash. When you flood the market with them, you are effectively printing money without admitting it. You are creating monetary stimulus that does not show up on the Federal Reserve's balance sheet. This was a deliberate choice. Policymakers knew that if they tried to fund the reindustrialization of America with long-term debt, interest rates would spike to 7 or 8% and crash the housing market. So they chose the inflationary path. They chose to debase the currency to keep the game going. And the market smelled it. That is why the dollar dropped 10%. It was the market pricing in the reality that the United States has moved to a permanent war footing in its fiscal policy. This brings us to the center of the storm, which is the artificial intelligence sector. We need to talk about the AI bubble, not as a technology story, but as a capital destruction story. The narrative sold to the public is that AI will generate trillions of dollars in new wealth and solve our productivity problems. And because of that narrative, trillions of dollars of capital are being sucked out of the real economy and poured into data centers and GPUs. But let us look at the mechanics of this trade. It is what we call a circular economy. You have a company like OpenAI paying billions to Oracle for cloud space. Oracle takes that money and pays billions to NVIDIA for chips. NVIDIA takes that money and pays billions to TSMC to manufacture the chips. And Microsoft injects cash into the whole loop to keep it spinning. The money is moving very fast in a circle, creating the illusion of prosperity. But where's the end user revenue? Where is the profit coming from the outside world to justify this spending? We saw a crack in this facade with Oracle. The company announced a massive $300 billion plan to expand data centers. The stock market cheered initially because the algorithm loves big numbers. But then the analysts started doing the math. They realized that to make a return on that $300 billion, Oracle would need to generate cash flows that simply do not exist in the current economy. The stock collapsed 50% from its peak. This was a warning shot. It showed that the market is starting to realize that the AI emperor has no clothes. But the United States government cannot afford to let the AI bubble pop. This is the crucial point. Washington views AI as the decisive technology of the 21st century. If China wins the AI race, the US loses its military and economic dominance. So the government has to keep the bubble inflated. They have to keep the capital flowing into these companies even if the economics do not make sense. This means more subsidies, more tax breaks, more government contracts, and ultimately more debt. The US Treasury borrowed over $1 trillion in a single 3-month period last year. Just think about that number. $1 trillion in 90 days. A decade ago, that was an entire year's deficit. Now it is a quarterly line item. This constant supply of new debt is overwhelming the bond market. When the Federal Reserve cut interest rates by 25 basis points. Recently, everyone expected mortgage rates and bond yields to fall. That is what the textbooks say should happen, but the opposite happened. Yields went up. Why? Because the market is choking on supply. It does not matter what the Fed does with the overnight rate if the Treasury is dumping billions of dollars of new paper onto the market every single morning. The price of bonds falls and the yields rise. This puts the Federal Reserve in a nightmare scenario. They want to lower rates to help the housing market and consumers, but they cannot control the long end of the curve because of the deficit. The only way to stop yields from rising is to print more money to buy the bonds. And printing more money kills the dollar. It is a trap. And right now, the policy is to sacrifice the dollar. While the US is struggling with its internal contradictions, the rest of the world is not sitting still. We are seeing a geopolitical shift that is accelerating the demise of the dollar. For decades, the US enjoyed what is called the exorbitant privilege. We could print dollars and the world would buy them because they needed them for trade. But that demand is drying up. The aggressive use of tariffs during the Trump administration started a decoupling process that is never reversed. When you put a tariff on Chinese goods, you buy fewer Chinese goods. That means China earns fewer dollars. That means China has fewer dollars to recycle back into US Treasury bonds. The natural flow of capital that kept the US system afloat is being cut off. And it is not just trade, it is trust. The freezing of Russian assets in 2022 was a watershed moment in financial history. It sent a message to every country in the global south. If you cross Washington, your money is not safe. It does not matter if you are a sovereign nation with central bank immunity. Your assets can be seized with the stroke of a pen. This shattered the illusion of neutrality that the dollar relied on. Now we are seeing the consequences. In quiet meetings in Singapore and Dubai and Shanghai, elite policymakers are planning for a post-dollar world. Singapore's former foreign minister, George Yeo, recently gave an interview that should have been front-page news everywhere. He warned that the US dollar is fracturing under the weight of its debt. He said plainly that if the deficits continue, the US will be forced to monetize its debt. Monetizing the debt is a polite way of saying hyperinflation. It means the central bank prints cash to pay the government as bills because no one else will lend them the money. When a respected diplomat from a neutral financial hub like Singapore says this out loud, it means the smart money is already moving. And where is that money moving? It is moving to gold. Central banks are buying gold at a pace we have not seen in 50 years. But they are doing it discreetly. They do not want to spike the price before they are finished accumulating. China, in particular, is swapping its US Treasury bonds for physical gold. They are de-dollarizing their reserves, not because they hate America, but because they are rational risk managers. They see a counterparty that is $35 trillion in debt and is promising to spend trillions more. They are simply closing their account. This shift to gold is part of a broader strategy by China to build an alternative financial architecture. They are expanding the Shanghai Gold Exchange. They are settling trade with Russia and Saudi Arabia in yuan. They are building a system where commodities can be traded without ever touching a US dollar. Every barrel of oil bought in yuan is a barrel of oil that does not create demand for the dollar. It is a death by 1,000 cuts. The technology war is also backfiring on the dollar. The US thought that by banning the sale of advanced chips to China, they would cripple the Chinese economy. It was a bold move, but it ignored the law of unintended consequences. When you ban China from buying NVIDIA chips, you force them to build their own, and that is exactly what they are doing. Chinese officials have signaled that they are done relying on Western tech. They view foreign chips as a national security vulnerability. Even if Chinese chips are currently slower or less efficient, the Chinese state is forcing its companies to use them. They are creating a guaranteed market for their domestic producers. This gives Chinese chip companies the revenue they need to innovate and catch up. So instead of killing the Chinese tech sector, the sanctions have actually birthed a powerful new competitor. We are moving toward a bifurcated world, one tech ecosystem run by the US and one run by China. And the Chinese ecosystem will not run on dollars. This permanently removes a huge chunk of the global economy from the dollar system. Europe is caught in the middle of this, and they are making mistakes that will accelerate the fracture. The European Union is debating whether to seize the frozen Russian assets and use them to fund the war in Ukraine. This sounds morally appealing to them, but financially it is suicide. The euro is a reserve currency because people trust the European rule of law. If they seize sovereign assets, they break that trust. Europe does not have the economic muscle of the US to get away with this. Their economy is stagnant. Their industrial base is collapsing due to high energy prices. If they scare away foreign capital by seizing assets, the euro could collapse even faster than the dollar. This pushes even more capital toward the neutral bloc of BRICS nations and toward hard assets like gold. So what does this mean for you and your financial future as we head into 2026? It means you need to understand that the rules of investing have changed. The 60-40 portfolio of stocks and bonds worked for 40 years because interest rates were falling and the dollar was stable. Neither of those things is true anymore. Bonds are no longer a safe haven. In a world of monetary debasement, a bond is just a promise to pay you back in currency that will buy less than it does today. If inflation is running at 5% and your bond pays 4%, you are losing money safely. You are guaranteed to lose purchasing power. This is what financial repression looks like. The government keeps rates below the real rate of inflation to burn away its debt at your expense. The stock market is also becoming a dangerous place for the passive investor. The gains are concentrated in a tiny handful of AI stocks that are priced for perfection. As we saw with Oracle and the other tech giants, the moment the growth narrative slips, the downside is 50% or more. You're playing musical chairs on the deck of the Titanic. The smart money is moving into real assets, things that cannot be printed: gold, silver, commodities, productive land, Bitcoin. These are the assets that perform well during periods of currency debasement. When the dollar falls, 10% gold effectively goes up 10% just to hold its value. It is not that gold is getting more expensive, it is that your money is getting cheaper. We also need to watch the political landscape. The second Trump term will likely bring more tariffs and more aggressive trade wars. While the intention is to protect American jobs, the side effect is higher prices. Tariffs are inflationary. There is no way around that math. If you tax imports, prices go up. If you deport millions of workers, wages go up. These might be popular policies, but they are inflationary policies. And how will the administration fight that inflation? They will likely pressure the Federal Reserve to keep rates low despite the inflation. They will want cheap money to fund the factories and the tax cuts. This is the recipe for the 1970s all over again, but with way more debt. We are looking at a period of stagflation where growth is slow, but prices keep rising. The most important takeaway for you is to stop thinking in nominal terms. Do not look at your portfolio and say, I made 10% this year, so I am rich. If the cost of living went up 8% and the dollar dropped 10%, you actually got poorer. You have to start thinking in terms of purchasing power. How many ounces of gold can your savings buy? How many barrels of oil? How many shares of the S&P 500? When you view the world through this lens, the picture is clear. The U.S. government has chosen its path. It has chosen to save the system by sacrificing the currency. They will print whatever is necessary to keep the bond market liquid. They will print whatever is necessary to subsidize the chip factories. They will print whatever is necessary to pay the interest on the debt. The warnings from Singapore and the actions of the Chinese central bank are not conspiracy theories. They are rational responses to a U.S. policy of debasement. The world is preparing for a post-dollar era. You should be preparing too. The decline of the dollar in 2025 was just the prologue. The main event begins in 2026. The structural pressures are locked in. The debt is too high. The spending is too high. And the political will to fix it does not exist. The path of least resistance is to let the dollar burn. This is not the end of the world, but it is the end of the world as we knew it. The easy money era of stable prices and global cooperation is over. We are entering the era of hard assets, fragmented trade, and currency conflict. Those who understand this shift will be able to protect their wealth. They will move out of paper promises and into real things. They will diversify away from the dollar. They will survive the transition. Those who ignore it and hope for a return to normal will find their savings evaporated by the silent tax of inflation. The choice is yours. The signals are flashing red. The insiders like George Yeo and the central bankers in Shanghai have already placed their bets. They are betting against the dollar. The question you have to ask yourself is, do you feel lucky enough to bet against them? Inside the global economy, we'll continue to track these flows. We will continue to watch what the insiders do, not just what they say. Because in a world of deception, capital flows are the only truth left. Stay vigilant. The game has changed and you cannot afford to play by the old rules anymore.